A very warm welcome to the second Income Tax Symposium, November 2025, organized by Educating and Tax Connect. I would now like to introduce our speakers, Mr. Vivek Jalan and Mr. Jayant Prakash Saha. Mr. Vivek Jalan is a qualified CA, MBA, LLM, and LLB. He is the partner of Tax Connect Advisory Services, LLP. He is the regular speaker at various professional forums, specializing in both direct and indirect taxes. Mr. Jayant Prakash Saha is a qualified CA. He is a diploma holder in Information Systems Audit from ICAI. He is also a certificate holder of GST, Forensic Accounting and Fraud Detection from ICAI. He is currently serving as a senior manager at Tax Connect. During the session, please put your video and microphone off. If anyone has any query, please feel free to write in the chat box. We will address all the queries at the end of the session.
Thank you to Educating for partnering with Tax Connect in the second Income Tax Symposium. Every month, we now would have these kind of symposiums to take your members of Educating as well as the other members, taxpayers, professionals, chartered accountant, cost accountants, etc. on the recent development of income tax. We would look forward to launching this Income Tax Act 2025 course with Educating. It would be a chapter wise, section wise course, and it would just not be taking through the provisions. While the CBDT and ministry have said that the act is simplified, which is also a fact. Income Tax Act 2025 is highly simplified, but we all know that in any tax law, even if one sentence changes, there are so many interpretations, and here the entire act has changed. So we'll come out with the differences, mainly the differences and the impact analysis of Income Tax Act 25 versus 61 in that course. So thank you once again, and I'll share my PPT. So now in this symposium, the second symposium, we'll not discuss only what has happened during the month, the income tax burning issues during the month. We'll discuss also on how practically we have solved the specific cases of issues of taxpayers, corporates which have arisen in income tax space over the last 1 month. What new notifications have come on the capital gain account scheme, and also we have had various interactions with the CBDT members and their concerns, the concerns of CBDT, and going forward how the taxpayers should also uh, sanitize their databases, etc., in sync and in consonance with the requirements of the CBDT. So first up, let's get started. The biggest issue today with taxpayers is the ex parte orders, which you can see on your screen. Ex parte orders, and why these orders are ex parte. Many of the time section 148 orders are received ex parte, that you have not complied with 143 2 notices, 142 1 notices, and therefore we are doing 148. This is because of a issue relating to the service of the orders and the notices. And the CBDT is also concerned. Very recently, we had a meeting with member CBDT, and he was also concerned. He said, see, we do not want to pass ex parte orders. Ex parte orders, the quality is bad, because naturally the officer has passed the orders to the best of his judgment with whatever data he has. We don't want to pass these orders but there is an issue with the service of the notices. We are serving the notices on email IDs. These email IDs are not accessed by the taxpayers. The mobile numbers sometimes are not accessed by the taxpayers, etc. So, what is the issue? So, they were taking our feedbacks also of the associations, chambers of commerce, etc. Uh, what came out of this discussion is these ex parte orders are happening because, as per this rule 127, if you see rule 127, it says that on the email, which email ID they will use. Now, there are email IDs which you give on the ITR. You would have filed the ITR, you would have given an email ID and a mobile number. So, they will take that. They will take the last ITR, email ID, and mobile number to serve the notices. However, many of the times, what taxpayers do is that those email IDs, mobile number may be those of consultants, they may be inactive, and they change the email ID and mobile number on the portal. Now, the question is that whether it is mandatory for the AO to check the email IDs, mobile numbers on the portal which have been updated, or he will just rely on the ITR email ID and mobile number provided. These where there many cases are there. Very recently, the Honorable Jharkhand High Court has ruled. There are Bombay High Court orders also that it is the prerogative of the assessing officer, right, that he will check whether there has been any change in the email ID and mobile number, because service of the orders and effective service of the orders are a jurisdictional requirement. Without a notice, without a effective order, it would not it would be jurisdictionally ineffective, right? It would be jurisdictionally wrong. It is on the assessing officer, the revenue, the onus is on them to show that the notice or the order they have been effectively serviced and the taxpayer has actually got the notice. In case all these requirements are not fulfilled, then these orders and notices, they would be liable to be quashed, and de novo assessments and adjudications would be ordered by the high courts. So this is the jurisprudence which has developed on this. However, now the question is what needs to be done. Well, the CBDT has taken it upon itself to sanitize these databases and to do mass outreach programs for the taxpayers, to sanitize their email IDs, mobile numbers, etc. So all of you here who are many of you are into your own, you are dealing with the taxpayers, maybe in the consulting space, you may be the into the industry, you may be handling many taxpayers, all your owners files, etc. So please sanitize your database, on at least on the income tax portal. We have also requested the CBDT that the email ID on the income tax portal, that also should be taken in addition to the ID which is given on the income tax return. Which brings us to the next question. Now, what is the law? I have told you about the rule 127. Now, for the service of notice, Income Tax Act 1961, you can see on your screen, Section 282 is the relevant section for service of the notice under Income Tax Act 61. Right? In Income Tax Act 25, it is Section 501. Now, here, if you see 282 on your screen on the left hand side, you will see that there are four modes of service which are said, and you will see highlight, I have highlighted or, the word or after each mode, A, B, C, right? So as per current Income Tax Act 282, it is said that the service of the notice may be by post or by the manner provided in CPC, that is by pasting the notice at the place of the taxpayer, or in the email or any other electronic mode as specified in Information Technology Act, or as may be otherwise specified, right? So the word use is odd. So they will either do through electronic mode or through speed post or through pasting it as per CPC civil procedure code requirement. But if you see in ITA 25, Income Tax Act 25, Section 501, which is the same as Section 282, you will see this word or is written only after clause C. It is highlighted on your screen, which means that in the Income Tax Act 25, they have taken cognizance of this fact that effective service of notice is important. So they will serve it through email ID, mobile number, and electronic means, plus by speed post or other post, plus in the manner as required by CPC if it is not received. Right. So again, as we said, even in this course, we will discuss very minor change. This is a very minor change, but if you understand it, why this change has happened, by understanding what are the burning issues in income tax as well as the jurisprudence, then you will understand that how to take the advantage of these changes in Income Tax Act 2025. Right. So very recently, the Madras High Court in the case of J Infotech versus Deputy State Tax Officer has also held that the service of the notice have to be not only legal, but it has to be effective also. It was a GST case after Sahiti Agency's case. So these notice services, service of the notice is very important in case you get an ex parte orders. Now as a into when we are into consulting, or when we are normally in a corporate, we are handling the income tax matters. If we get an ex parte order, then immediately we start preparing the reply to that order. We start preparing the documents, which is right. But you should also take these legal grounds. Ex parte orders does not look good upon the taxpayer, does not look good upon you as a professionals. So in case you do get it, you must see all of these jurisprudence as well as the section which is how where service of the order can be contested. However, the same jurisprudence has evolved in the Bombay High Court. Bombay High Court, in the case of Chitra Supekar and Lok Developers, it has held the same, that it has to be effective. The notice and the order that should be actually received, it should be an effective service. But the same High Court, Bombay High Court, very recently in the case of Cross Television, in Cross Television, it has said just the reverse. That look, while it is the onus is on the department to do an effective service, yet in case the taxpayers dodge the notice, then the taxpayer would be considered to be evading the taxes and the rule of law, and therefore action would be taken. So, we also had a taxpayer who was expecting a notice, and the notice was being served on the last day. The email IDs were ineffective, etc. They knew that the income tax department would come to their office and serve the notice, and they closed the office on the last day of the notice, being knowledgeable of this. And you see, they wanted to take the ground that even after the income tax officer pastes the notice on their main gate, it would not be an effective notice. So in our view, that should not be done. And the evasion of the law is not at all recommended in the present age, where a lot of things are recorded. But yes, in case the notice is not effectively served, then you certainly have the various solutions at your disposal. Next, issues, TDS and TCS issues. The recent issues, we all know, many of us, we continue to do TDS, TCS, return filing, etc. So many rectifications are there, so many errors are there in the returns. Sometimes while doing all the compliances, we forget the law. We do not, sometimes we skip how we can take the shelter of the law. Plus, in the TDS, TCS compliance space, it is very important that you know of the recent developments and how to take the right calls as and when the issues arises. So first thing first, there is a major change in TDS and TCS, right? Now, as of now, as per Income Tax Act 1961, as per section 200, you can rectify your TDS TCS statements. Earlier there was no time barring limit for rectification of TDS TCS statements. Now after 2024, in the budget they brought about an amendment, and now the TDS TCS statements can be rectified for 6 years, right? So currently till March 2026, March 2026, you can rectify the TDS TCS statements from financial year 18-19 to 2023-24 third quarter, right? So 2017-18, April 2017 to December 2023, you can rectify the statements till March 2026, right? However, in the new Income Tax Act, which will take over the existing Income Tax Act from 1st of April 2026, this TDS TCS rectification time limit has been reduced to 2 years. Now, what does that mean? That means that from till Q3 December of financial year 23-24, before that you cannot rectify any TDS TCS statements after 1st of April 2026. So after 1st of April 2026, you can only rectify TDS TCS statements from Q4 of financial year 23-24, right? So over the next 3 months, you have 3 to 4 months, December, Jan, Feb, March. Please relook at whatever TDS TCS statements are there from 17-18 to Q3 of financial year 23-24. If you need to rectify, please rectify. After this, that opportunity would go, right? So very, very important to understand this. Another very important development. The development happened in 2023. Now in this new Income Tax Act 25, it has been further crystallized. So this new Income Tax Act 2025, which will be applied from 1st April 2026, and actually which has, a lot of changes are there which have actually started being implemented. This is the second of them. Now, we receive low TDS deduction certificate or nil TDS deduction certificates, right? From our suppliers, vendors, etc., right? So when they give us the certificate, we deduct the low TDS subject to the limit, right, which is mentioned in that certificate. So for example, I am A, I get a low TDS deduction certificate from my vendor B, and my limit is 1 lakh rupees. So till 1 lakh rupees, I deduct low TDS or nil TDS as per the certificate in form under section 197, right? 197A, that is what is served to me. In the new Income Tax Act, section 395, right, which will apply from 1st April, and already the procedure has started. This requires, or this also empowers the officer to cancel this low TDS deduction certificate during the year, right? So therefore, as a deductee, what comes out is, whenever you get a low TDS deduction certificate, already the process has started, friends. You can see on your screen, I have attached a screenshot, right, of traces. Already, while the order notification 2/2023, they have started online tracking of low TDS deduction certificate. If you go to your traces, you will see all the LTDS certificates of your suppliers or vendors which is issued in your name, right? And you see on your screen, while it did not come out very well, but if you can see little bit, two important things are there. Number one, this amount I was referring, 1 lakh rupees is the amount limit for me, right? As a deductee. So this consumption of this 1 lakh rupees, this will be tracked online, right? If you can see online, they have serial number, certificate number, financial year, pan of the deductee, matlab your pan number, name of the deductee, your name, valid from, this certificate would be valid from, valid to, and see again there is a column for cancel date, which means that even now they have started taking this step of cancellation, or in future, the moment this income tax act 2025 uh, is effective, they will start this feature of cancelling LTDS deduction certificate in case of any issue, right? So that is there, and certificate limit and amount consumed, last two columns, certificate limit and amount consumed. So in my example, 1 lakh rupee limit, 1 lakh rupees was my certificate limit. How much of it has been consumed, that will be tracked online, right? So this is very important. If you are getting a LTDS deduction certificate, you should also start tracking it. If you are doing an audit of any of your taxpayers, if you are doing internally, you are handling for your clients or your company, this should be an important checkpoint for you. Another important issue in TDS TCS. Now, most of us, or many of us, many of the times, we think issuing of TDS certificate, TCS certificate is a waste of time, right? We also think that it is not a very effective compliance in today's age. In fact, we have represented before the CBDT to withdraw this TDS TCS certificate issuing compliance. We have represented that, see, today also TDS TCS credit is given by our officers only if my TDS TCS is reflecting in the form 26AS, right? So TDS TCS certificate is a waste of time. Very recently we have also represented before the CBDT, when the member CBDT was there. Their view is that, see, there is a section 205, right? If you go to section 205, they say that even if the TDS TCS credit does not reflect on your 26AS, right? But and you have claimed the credit, so maybe the credit may not be made available to you, but the TDS TCS form, that creates a footprint and no recovery will be made from you for the credit which you have claimed, right? However, we feel that again that is a far-fetched thought, but nonetheless, till the time this TDS TCS certificate compliance is there, so many of the times we miss this. Under section 203, friends, it is very important that within 15 days of the filing of the TDS TCS returns, within 15 days from the traces, you have to generate the TDS TCS certificates and serve it to the deductees, right? Otherwise, there is a penalty of, I have written 100 rupees. This has changed to 500 rupees. Per certificate, you may be charged a penalty of 500 rupees per day for delay, right? So for your return, TDS TCS return, which you have not filed, which you have filed on 31st of October 2025, if till today, today is what, 29th of November, you have not generated TDS TCS certificates from traces, then per certificate 14 into 500, 7,000 rupees has accrued. Okay, of course it is subject to the total TDS TCS amount, but this is the kind of onerous penalty under section 272A which is there. So again, uh, while may not be a lot of value add in this compliance, but it is still a mandatory compliance. Two important cases, two important opinions. As I said, we'll discuss on the practical cases which we have handled, practical opinions from Tax Connect we have given. So, two important opinions on TDS. There was a question, right? I think most of the corporates nowadays, they have corporate club memberships, right? It is easier to get a corporate club membership, so they take a corporate club membership to for the refreshment of their clients, holding client meetings, etc., etc., right? In every city it is the norm that you can go to a club and have your corporate meetings, corporate seminars, etc., etc. Most of these meetings is with some refreshments, snacks, etc. So most of the time the club membership, there is a fee, annual fee, which is a hefty amount most of the times. And the if you see the bills, the club bills, it is mainly towards the consumables, eatables, right, which you go and have while meeting with the client. Now the question was that whether this club membership fees and the club membership expenses, whether they are allowable as a deduction. In our view, from the very beginning, yes, it is this expense is for business purpose, and hence it is fully allowed as a legitimate business expense. It is used for profit earning of the organization, right? It was also held by many high courts. Bombay High Court, Swiss Re Services India Private Limited is upheld the deduction taken for club membership expense under Section 37, general section. Right now, Section 37 of Income Tax Act 1961 will become Section 34 of Income Tax Act 2025. The issue was whether TDS is to be deducted on this club membership fees. Right. See, in our view, so we have opined that yes, TDS under Section 194C would be deducted and on this club membership fees also. A question was asked why. We said, see, on 194C, the TDS under 194C is on works, right? And work has been defined under 194C as an inclusive definition. The definition is work shall include catering. And most of the time, these club memberships is taken to go and use it as a restaurant where you are served food. So in our view, that work should include any other service like catering also, which includes these refreshments and a place to take the refreshments which the club offers. Therefore, in our view, TDS under 194C would be applicable on this club membership fees. Another very, very interesting topic on which we have provided our opinion. Say, for example, you have a supplier. Okay. You have a supplier and you take some service. Say you have a contractor. You have given him the contract to renovate your office. The contract amount is, say, 10 lakh rupees. Now, after that, he gives you a cost escalation of 5 lakh rupees. You pay him 10 lakh rupees, but you say, no, this 5 lakh I will not pay. So he litigates, he goes to court, etc. You fight a battle for the next 5 years in the court, and nothing happens, right? In the commercial court, we know that things move slow. So after 5 years, you and your contractor, you sit down and you say, okay, let it be, forget the battle, we will settle at 4 lakh rupees, right? This dispute. Or even if you get the order after that also, you come to the table, you say, okay, fine, I will not go to the high court or the higher courts, let us settle over here. I will not go to the district court, let us settle over here at 4 lakh rupees. So both of you settle at 4 lakh rupees. The question is, will TDS be deductible under Section 194C? In our view, no. Why? Because it is not a payment as a contractor, right? It is a payment of a settlement amount. A mutual settlement agreement has been entered into, and as per that mutual settlement agreement, it is the payment as a mutually settled amount. Now, a question was asked, the TDS, whether TDS would otherwise be deductible. In our view, we have opined that TDS would be deductible under Section 194 capital R at the rate of 10%, right? Why? Because 194R is on benefits and perquisites. It is not a perquisite, but whether it is a benefit, in our view, yes. And even a benefit in cash is covered under 194R, read with Circular 12 of 2022. So in this case, we feel that TDS under 194R would apply on these mutually settled agreements also, right? Again, a very, very important change this time in tax audit has been the reporting under section 43BH. Jayant will take you through the returns, right, and the changes in the returns which you will be filing on 10th of December. But 43BH, already in the tax audit reports, all of you have reported what is the non-compliance by payment to the MSME after 15 days or 45 days. Now, the a very, very important question has come on this 43BH. Also, all the corporates, they are filing their MSME forms on the ROC portal. Even ROC has a MSME form requirement, right, to file. So let us understand 43BH a little for 1 minute, and then I will come to the issue. This is a very important issue. I think all of you, I think none of us, in fact, would have concentrated on this point, but this is a very important point where you can save a lot of money, I would say, on this 43BH add backs. Now, section 43BH requires that for the SMEs, that is a small and micro scale enterprises, for if you are paying them, they are registered on the Udyam portal. Then if there is a contract, you have to pay maximum within 45 days or the contract amount. If there is no contract, then you have to pay within 15 days. Otherwise, there would be disallowance under 43BH, and the amount would be allowed as a deduction in the year in which you actually make the payment to the SME, right? That is the norm. And they have referred section 15 of the MSME Act. The time of this 15 days and 45 days is as per section 15 of the MSME Act, right? So, in simple terms, if you pay to your SMEs who are registered on the Udyam portal, even if there is a contract, after 45 days, from say 31st March 2026 comes, and you pay your MSME on 1st of April after a elapse of 45 days. So that amount would be added back for the previous year 25-26, assessment year 26-27, and would be allowed in tax year 26-27. I am using the word tax year, right? It is now that will be the concept in Income Tax Act 2025. Right? Now the question is, now listen to this very carefully. In case of traders, you all know that this 43BH is not applicable when you receive any goods as sale from your traders. There 43BH is not applicable. Now I will give you, so there is this office memorandum of 2nd July 2021, and thereafter again there is a office memorandum which has further reaffirmed this, right, in 2021 itself. Now, two scenarios have come to us for our view. First scenario, in case the supplier is supplying you goods. So, for you, he is a trader. He is just supplying you goods, right? Pure trading. But in the Udyam portal, he is registered as a manufacturer or service provider. The question is whether 43BH would be applicable or not. In our view, it would not be applicable. Section 15 of MSME Act, the benefit would not be applicable because the nature of the activity, the trade has to be seen, not the trader, right? So trade is very important. Trade is it is a trading of goods. Even if the person is registered as a service provider or manufacturer, it would be uh, this section 15 and 43BH disallowance would not be applicable. Second is, take the reverse scenario. If he is actually supplying you a service, but he is registered on Udyam portal as a trader, even in that case, that activity is important. In case it is a service activity, then ideally it should be applicable. But here you can take a view, a call that yes, he is not registered as a service provider, and therefore section 15, there is a non compliance with the MSME Act by the supplier, and therefore it would not be applicable. But again, this view would be a very contracted view. In our view, there also you cannot play hot and cold at the same time. So there also you should take a call that yes, if the activity he is giving me is a service or a manufacturing activity he is doing on my behalf, a job work, then 43BH read with section 15 of MSME Act would apply, and this 15 days and 45 days time limit would apply, right? So very now Jayant would take you through the ITR forms, and already you have done your tax audits, right? But even if in the tax audits you have shown this as a disallowance, right? But now is the time when you are filing your ITRs, you can revisit, and in case you feel he's a trader, then you can actually not allow to do that deduction, right? You cannot you, you can not add back this amount where you're not paying a trader. Next, capital gain accounts, second amendment scheme 2025. This has been notified I think in the last week only. Very simple. We all know that there is a capital gain account scheme of 1988. What is this scheme? We all know that if you have a long term capital gain for sale of property or otherwise, and if you invest in construction of a house property, or you buy a house property, construction within 3 years and buy of a house property within 2 years, then uh, subject to the conditions therein, the long term capital gain would be considered to be exempt in your hands under section 54. Now, we all know that in case you cannot buy before filing of your return where you have long term capital gain, you cannot buy or construct the house, then what do? You put the long term capital gain or the sale value or the purchase value or construction value in this capital gain account scheme. You put it in a bank, right? And within 3 years or 2 years, as the case may be, you have to utilize that amount to stay exempted. Otherwise, in the year where you violate the condition, then you would have to offer it for taxation. There is a lot of relaxation on this. Majorly three relaxations in this new capital gain account second amendment scheme to 2025. First, as of now, there were only nationalized banks were allowed to open this capital gain account scheme accounts, right? Now they have expanded it. If you see notification 62, you will see that a host of 19 banks, including Bandhan Bank, etc., etc., they have also been given now the charge of opening these accounts, right? So capital gain account you can open in these other banks also, HDFC, ICICI, Bandhan Bank, so many other banks are there, 19 banks. But of course it has to be a non rural branch. Now, very important, second, you know that in this capital gain account scheme, the payment was only through the check or draft, etc. Now you can make a payment into these accounts. You can open this account in this bank capital gain account, and you can make the payment over there through online mode, credit card, debit card, net banking, IMS, etc. Right? Very, very important change. Third important and very important change is for closure of this account. It was a completely manual process. Now it can be done through digital signature or EVC. And also the electronic statements, you don't have to go and run around through a passbook. You can get it through electronically. You can get the statements. Last, one more important thing, there was always a lot of dispute that everybody, the like in taxation, it happens on the last day. The taxpayers, they want to do a lot of things, and always there is a litigation over I have made the payment of the money, but so my date of payment should be considered as the valid date of the credit also. Now they have clarified that nothing doing, even through electronic mode, you make the payment, but when the deposit account is credited, right, only then it would be considered to be paid. So before filing of the return, you have to get the account credited, right? Do not wait for the last day. Also, our industrial undertaking under 54 GA, they are also exempt if they buy capital assets in the SEZ. If they transfer from DTA to SEZ under 54 GA, they can buy capital asset and it would be considered to be exempt subject to conditions. So that also comes into this capital gain account scheme. Also, the closure of this account under form, very important. Again, one more thing is that closure of this account in form GH, there are two forms in that scheme, that will all be online now, right? So this capital gain account scheme primarily now will be more liberalized, if so to say. uh, we all know, in income tax or in any taxation, in income tax specifically, penalties handling is also an art. Why it is an art? Because there is a quantum order, there is a penalty order, right? First quantum order will come, and thereafter penalty order will come. So let's take a case that in the quantum order, say for example, you have disclosed certain expenditure which is disallowable in your ITR, but somehow due to some mistake you have not added it back to your income, right? Because it is disallowable. Maybe it is a capital expenditure. Disallowable, you have disclosed it in your ITR, in your P&L account, statement of profit and loss in the ITR 6, so to say. But you have forgotten to add it back in the computation. Now, there is an assessment. 143.2 notice is there. And you admit, right, that yes, that is a mistake, and you make the corresponding payment of the tax and interest. The question comes whether penalty would be applicable on you or not. So once this is done, quantum order is taken care of, immediately there would be a order for penalty, right? Penalty takes various forms, section 270A, section 271, etc., etc. Now, similarly, we got a case, many cases are there. So here, whenever you get a penalty order, let us understand what are important. First of all, you must see what is the allegation under you. If the assessing officer, he just says that penalty under section 270A is applicable, that order is liable to be quashed. Why? Because he has to make a specific allegation under section 270A. He has to make a specific allegation whether it is due to underreporting or due to misreporting. Underreporting has also been defined under 270A2, and misreporting has also been defined under 270A9, right? So if he says that, okay, your penalty would be under section 270A2B for underreporting, which in our case it happened. The officer, the taxpayer showed in our case the amount of expenditure in the ITR, forgot to add back. The officer levied 278 2B. Now 278 it has two limbs. Number one, where the income assessed is greater than the threshold limit, where no return is filed or return has been filed under section 148. In this case, he has actually used the wrong limb. He should have invoked section 278 2C, where income assessed is greater than the income actually assessed in the return, right? But he used the wrong limb. So this is a valid case for quashing, right? Another thing is, you must see the case law. In this, our case, the officer used the Delhi High Court judgment in the case of Zoom communication. In the case of Zoom communication, Delhi High Court has distinguished the Supreme Court judgment in the case of Reliance Petro Products. It has said that, see, in that case, there was a separate situation. But in Zoom communication, Zoom is a very big entity and it has many auditors. The audit was also done and the professionals are also there. And in this Zoom communications case, the SSE has not stated the circumstances and the person on whose account the mistake has been made. So now you can distinguish. In your case, you have to see, you have to read that case and you have to distinguish. We distinguish it, we said, see, in our case, the person who handled the tax matters at that time left, and that was his mistake, and therefore you can distinguish the case. So again, handling of penalty, you have to see the limb which is used. Similarly, 271 1C cases are there, where the officer sometimes forgets to state whether it is concealment of fact or inaccurate facts. So there you can fight on these, and most important is the facts of the case, how the facts of the case are different than the jurisprudence which has evolved. That is important in tax litigation cases, specifically in the penalty cases. Again, you see, penalty can be levied for willful attempt to evade the tax, 276C, and very important, 276C, for filing the failure to file the return. Even if you fail to file the return, then penalty can be invoked upon you. Even punishment, imprisonment can be there. But these cases have also to be defended based on the fact that whether you are actually paying the tax or you have not paid the tax. After you have paid the tax, there is no question of imprisonment, punishment, etc. However, for TDS, it is different. 276B is applicable. So TDS, you have to be careful. If you have deducted but not paid, it is a criminal offense and there is no willfulness attached. TDS, if you deduct, not pay, then you cannot say that it is non-willful. Right? So,
Sir,
as I
sorry
said,
to interrupt. Hello. Sir, your screen is not being shared. Can you please share it?
not shared.
I think it has been.
Now,
Not yet.
justice.
Yes, sir, it is there.
Now it's there. So last, on these, as I said, tax litigation, handling is an art. You should not only focus on the legal points, you should focus on the factual points and also the procedural points. You see, the Supreme Court has held that section 2, article 265 of the Constitution it also dwells upon the procedures in tax laws. So 143(2), you see, many of us, whenever we are dealing with scrutiny cases under income tax, uh, the first notice is served under 143(2), right? And thereafter there is a scrutiny. Now, very important, as per CBDT instruction number 225 of 2017, the officer in the first notice under 143(2), he has to state whether it is limited scrutiny, complete scrutiny, or compulsory manual scrutiny. What do you see currently? And we have raised it before the CBDT also. Nowadays, you see that they don't state anything in 143(2) notices in the very beginning. At the end, in the order, they state that yes, 143(2) was raised because of this limited scrutiny or complete scrutiny, right? But that is not the law. The instruction in 2017 is very clear that 143(2) notices themselves, in the very beginning, they should have the point whether it is limited, complete, or compulsory manual scrutiny. And in a similar case, the Kolkata bench of ITAT, in the case of Hind Ceramics, had quashed the complete assessment procedure because of the faulty 143(2) notice. Right. Similarly, you may take up the jurisdictional issues, whether the jurisdiction of the person, the assessing officer, is there or not, right? Whether the central circle jurisdiction is there or not, right? If you mind that, you see, again, I will quote one more case. Yeah. See this case, Sushil Kumar Subhash Rao Deshmukh. Here, in the appeal stage, at the adjudication stage, maybe some person has handled it, he was not so efficient, they did not question 143(2) notice. But at the appeal stage, they questioned 143(2) notice. Now that is not right, right? Then you will not get a relief at the appeal stage because you have already participated in the proceedings, right? So if you participate in the proceedings without challenging the notice itself, then the case is closed. You have to, first up, whenever the notice comes, you have to see whether it is procedurally correct and question that notice first up itself. Thereafter, maybe you can participate, but the very fact that you have questioned it notice first up, that makes the notice defective, right? In case afterwards they do not clarify before the order. So very important. I would, our next speaker Jayant is there also, who would take on the returns part. So I would close over here with finally the fact that tax litigation always look at facts, law, and also procedures. So with this, I would hand over to Jayant, who would take over on the returns filing part.
Thank you,
Jayant,
Vivek sir. Yeah, thank you, Vivek sir. And good afternoon to all the participants. We'll first like to thank Educating for partnering with Tax Connect for this income tax symposiums. And in the months to come, we'll have every month more such symposiums for benefit of all. I'll quickly share my screen. Yeah, so we'll today quickly discuss on the income tax returns, the changes in the income tax returns that are due on 10th of December. As we all know that White Circular 15 2025 dated 29th October, the due date for filing the income tax returns for the audit cases has been extended to 10th of December. So we'll just quickly, during the last few days, we'll just quickly check on the important pointers that needs to be taken care, and which will be important from the litigation standpoint also. So quickly going forward, just a second. Yeah. So the first change that is there, that is very critical from a litigation standpoint, is the schedule of AL, assets and liabilities, that is there in the ITR 213. So earlier, till the last year, this schedule was mandatory for SSEs whose total income was not was exceeding 50 lakhs. Now that limit has been increased to 1 crore. So now the scheduled AL is mandatory for all the SSEs where the total income exceeds rupees 1 crore. Now, it is important here to link this schedule AL with another schedule in the ITR 2 and 3. The another schedule is schedule FA, foreign assets. We must be knowing that during the last financial year, during November 24, the CBDT had launched a compliance cum awareness campaign for this foreign assets and liabilities. It was basically to ask the taxpayers who had foreign assets and incomes to basically disclose the foreign assets mandatorily in their ITRs. And after the campaign was over, we see that many SSEs had disclosed voluntarily and some did not disclose. And after that, various notices were issued for this foreign assets to many clients. The schedule AL is also similar to that foreign assets because those foreign assets which will be disclosed in that schedule FA will also need to be disclosed in this schedule assets and liabilities. And recently we got a notice for a client where the client being an exporter, he did not disclose both these schedules and he was scrutinized and he was asked to disclose both the schedule for foreign assets and liabilities and incomes, including the assets and liabilities. So what we see is going forward, the department will take these disclosures very seriously. And in case these are not disclosed, there may be consequences, including penalty proceeding and scrutiny. So in Tax Connect, what we have done is from the very beginning, we have tried to adhere to this schedule and we have always disclosed the schedule of AL and FA. So this is a important change, although not directly relating, although they have given a exemption till 1 crore, but still, if you are you have the record, then it's advisable that you should include this information in the income tax returns that you are filing. Now moving on to the next slide. Just a second. Yeah. The second change that has been there in the current income tax return is that we'll now need to disclose the section under which the TDS is deducted for the scheduled TDS. So in our 26 A's, we have various sections under which the TDS is deducted that is being reflected. It is important for us to map these TDS that has been deducted to the respective incomes. So critical here is that for example, there is a section 194R that is for the TDS for any benefit or perquisite that is arising from business or exercise of the profession. So for example, there has been a foreign trip that has been provided to us for sales promotion meeting or another gifts for which the deductee has deducted TDS under section 194R and that 194R TDS is being reflected in my EIS and 26 ES. Now, this value of benefit of perquisite that is arising from business, it is also taxable under the head PGBP under section 28(4). So it will be important for us to map this TDS and the corresponding income in our income tax return under the head PGBP. If there's a difference, then obviously we'll be subjected to scrutiny on this part. Similarly, another section is there for TDS for cash withdrawal under section 194N for cash withdrawals exceeding 1 crore. So suppose if there is a TDS deducted under section 194N and there is a cash withdrawal for exceeding 1 crore, in such cases, it is important for us to have a reconciliation of the cash that has been withdrawn vis-a-vis the expenses that has been done through that cash. This reconciliation is important for assessments and scrutiny because obviously the TDS under section 194N for a cash withdrawal of more than 1 crore has to be substantiated to our records. In this line only for the AIS, it is important that we take care of whatever it is appearing in the AIS, especially the bank interests, mutual fund transactions. Also, there will be some credit card expenditures and foreign remittances which are included in the AIS, and the corresponding records and disclosures in the ITR is also important for us. So mapping of AIS and 26 AS with the ITRs filed will be very important from a litigation standpoint in the future. Coming to the next change is basically with respect to the disclosure of opting out of the new tax regime. So as we all know that now the new tax regime is the default regime and we can opt out of the new tax regime. The salaried persons can opt out every year, opt in and opt out. But for those who are PGP income, they can only opt out once in a lifetime. Till now, till the last year ITRs, there was no option to disclose if we had earlier opted out of the new tax regime. But now from this year's ITRs, we have an option to disclose whether we have opted out earlier for the new tax regime. So basically it will be used to track whether we are availing this option of opting out more than once. In case we use it more than once, then this will have impact on the assessments and you may get notices for the fee for the same. Okay, moving on to the next amendment. The next amendment is with respect to capital gains. We all know that while the budget 2024, there has been a big change in the taxation of capital gains with effect from 23rd July. Earlier, where the STCG under 111A was taxable at 15%, and LTCG was taxable under with indexation benefit at 20% under section 112. And for 112A for shares and equity oriented mutual funds, it was at 10% without indexation. The same was changed from 23rd July 24. And the rates were changed where STCG was now moved to 20% and LTCG was moved to 12.5% without indexation. So this change has been there properly worked out and has to be separately reported in this ITR this time. Where whatever transactions are there before 23rd have to be separately reported, and transactions after 23rd have to be separately reported, and the tax accordingly will be calculated. It is important here. One point is important that there has been a grandfathering provision for the land and buildings. Only for the land and buildings. If the land and building was acquired before 23rd July and now sold after 24th July, then we can use the grandfathering provision where we can calculate the long-term capital gains as per the old provision of 10% with indexation. However, it is important to note that here only the long-term capital gains can be this option can be used only for the long-term capital gains. For the long-term capital losses, that loss cannot be carried forward and that will lapse. So this grandfathering provision will be important and there has to be a detailed working for this. Now, the next change is there with respect to the buyback provisions of shares. So earlier, before this provision has been changed on 1st October 2024. Before 1st October 24, the buyback was taxable in the hands of company under section 115 QA. But after, and it was also exempt in the hands of shareholders as per section 1034E. But after this amendment with effect from 1st of October 24, this buyback will be taxable in the hands of shareholders. Now, if you are a recipient of this buyback proceeds, you will have to now report this buyback proceeds under deemed dividend section 222F. So if you see under schedule other sources, there is a separate disclosure for this deemed income under section 222F. The buyback proceeds will now be taxable under other sources. Now, what will happen to the cost of acquisition of these shares for which have been bought back? The cost of acquisition of this shares will be now taken as a capital loss. It will be reported in the schedule of capital gains. So basically, the cost of acquisition will be as it is, and the sales consideration for the shares will be taken as nil, and the resulting capital loss that is arise, it may be short term or long term. That capital loss will now be available for set off and carry forward. So there has been a reporting change in the buyback proceeds, which has to be taken care of in this ITR. Now, the next change that is there in this ITR is with respect to the disability certificates for section 80DD and 80U. So we all know that under 80DD and 80U, there is an deduction that is available to the SSE for multiple disability, cerebral palsy, and autism. And for claiming this deductions, he has to have a form issued by the medical authority in form 10IA, or the same can be in another disability certificate. So it may be either 10IA or the disability certificate. Earlier, only the date of filing of form 10IA and the acknowledgement number of that form 10IA was there to be reported, the field for that. But now they have also included a separate field to report the acknowledgement number of this disability certificate other than the 10IA. So this is a small change. Okay. Now coming to the enhanced disclosures that are required in this new ITR. The ITR for this year has a enhanced disclosure for all the deductions and exemptions that we are claiming. So for example, we are claiming an exemption for HRA, house rent allowance. In the earlier ITRs, what we have been doing is that we are only reporting the amount of exemption under section 1013A directly. We were not required to report the breakup or the calculation of that HRA. That has now been changed. Now we have to provide a detailed disclosure of how that HRA amount exemption is being calculated. This detailed amount includes the place of work, actual HRA received, the rent paid, the basic salary and the DA that is being used for calculation of that HRA, 40 or 50% of basic, and whether it is a metro or non-metro city. So we'll have to have all the figures and all the disclosures separately reported there, and the system will automatically calculate the HR amount. Now here we have certain cases which may need attention. For example, we need to now report the place of work. The place of work reported. So for example, suppose there is a person who stayed with his family in Hyderabad and was having a rented accommodation there. During the year, he shifted to another company, maybe in Delhi. And for the shift, he went alone to Delhi and had a bachelor accommodation there. So now he has two rents. One is in Hyderabad for his family, which possibly is more than his Delhi bachelor rent. In such a case, he will obviously take the benefit of the rent, the more enhanced rent that he is paying in the Hyderabad region, but his place of work will be in Delhi. So there will be a mismatch between the place of work that is reported and the HRA exemption, the rent for which he is claiming the HRA exemption. Although the law allows, the law does not disallow that we cannot take the rent for Hyderabad, but still there may be questions for this. Also, it has to be seen that if during the year a person changes his place of work from a metro to non-metro city due to transfer or similar reasons, then there is no separate place to report both these. So this needs to be seen. Similarly, for the home loan under section 24B, now there has to be separate disclosures for the name of the loan giver, the loan account number, date of sanction of the loan, the amount of loan, and closing balance and interest for the year. Normally, when we get the interest certificates from the bank, the interest certificates do not disclose all of this information, right? So this needs to be taken from the banker, and then all of this information has to be correctly provided in the system. The reason for this is that, so for example, we have the closing a balance of the loan and the interest amount. So if we misreport it for the next year when you are claiming the exemption, the system may extrapolate these information to have a figure of interest which may not match with our disclosed interest, and you may get a notice for that. So it is important that we disclose the accurate information here in order for the income tax department to verify it correctly. Similarly, for ATC, ATD, we have additional documents that will be required. ATC, for claiming the deductions, we need to provide the document numbers or the receipt numbers or the insurance policy numbers for which we are claiming the deduction. Also for ATCCD, where we are availing the deduction for NPS, the PRAN number or the permanent account number has to be declared. Similarly, for LTD, health insurance premium, we need to declare the name of the insurance company and the policy or document number along with the amount of deduction that we are claiming. Similar deductions, similar disclosures are also required for other sections like ATE, deduction for education loan, and for the electric vehicle. So these are, whenever there is a loan for which we are claiming a deduction, the total information for that loan has to be declared in the income tax returns. I've already covered a part of this next slide. So for the crypto and foreign assets, we'll have to report separately in schedule VDA, the acquisition and the cost. And for the same as also if there is a foreign exchange where the crypto is being traded, so that part also has to be reported in the schedule of foreign assets. Okay. So the next part is the higher limits for the presumptive taxation. As you all know that currently, for where the cash receipts is less than 5% of the total receipts, small business owners have the opportunity to now choose the presumptive taxation, where the business turnover is up to 3 crores and professional receipts is up to 75 lakhs. So this has been included in the new ITR. There are other changes in the ITRs, such as in ITR 1, 2, small changes like in the ITR 2, we have a new field to report the interest received on income tax returns. We have now separate section to report the pass-through income from REIT and InvIT. Also in ITR 7, there is an important change there where we have to mandatorily report the FCRA registration number and details of foreign contribution that we have received, and the breakup of expenses for the religious and charitable purposes. So all of these additional disclosures have to be provided in this new ITR, which is due on 10th December. Although most of us might have filed the ITRs, for those remaining, it is important that we take into account the checkpoints, which will be important in the future for litigation and assessments. That's all from my side. Thank you for your patient hearing. Over to you, Vivek, sir.
Yeah, thank you, Jayant. I think you have covered things in great detail. There are few questions I have already replied to it. One very good question with Mr. Suresh Gupta has asked is you can type, Mr. Goenka, you type your question over here in the chat box. Mr. Suresh Gupta has asked that notice under 143.2, if it does not have the details as per the CBDT instruction in 2017, whether it would be quashed. Yes, in fact, in ITAT Kolkata itself, in Sajal Biswas's case, the Honorable ITAT had quashed 143.2 notice, the order under 143.2 based on a defective notice under 143.2, because the order was considered to be without jurisdiction based on a notice which is without the jurisdiction. So that is why it is very important the moment you reply to a 143.2 notice, and if it is not there, you should state this. We discussed it when we were discussing with the CBDT also. Many of the times what happens, the once the notice comes 143.2 first notice, they do not write. whether it is limited scrutiny or complete scrutiny, when the just before the order they write that yes, the notice under 143(2) because of a limited scrutiny or etc. So even that, it is without jurisdiction. That notice would be considered without jurisdiction. CBDT has taken note of it, and possibly we would see certain improvement going forward. Yeah, Mr. Goenka, you had raised your hand. Okay, so I think all the questions are answered, which is there in the chat box. Thank you very much to Educating once again. Uh, Thank you to Team Tax Connect for holding this symposiums and on income tax. And thank you, everybody. Thank you, Jayant.
Thank you all.
Thank you.
Thank you, Vivek sir, for the wonderful deliberation. Thank you, Jayan sir, for this wonderful uh, session. Now, I would like to ask Pranjal from Educating to give the thanking notes. Over to you, Pranjal.
Hello everyone. On the behalf of complete educating team, Arun sir, Pooja ma'am, I would like to thank Jayan sir as well as Vivek sir and Tax Connect team for such a knowledgeable and fruitful session today. And thank you everyone for joining the session. Thank you.
Thank you.
Thank you.
Thank you, Pranjal. We would be sharing the PPT on your mail IDs. Thank you so much for connecting.